Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. Today's episode will be very much focused on the economy, especially since today, Wednesday, the National Bureau of Statistics in Beijing published a whole slew of economic numbers, which we're going to go through. The first half of the video is somewhat dry, but quite important to take note of, and then we move into the numbers in the second half of the video. First up, we have 2 speeches from top leadership to cover. Yesterday, Tuesday, General Secretary Xi Jinping, at the opening of a study session at the party school of the Central Committee, made a speech on, quote, staying committed to the path of financial development with Chinese characteristics and boosting the high-quality development of the financial sector. End quote. Veteran China commentator Bill Bishop observed on the move today that these meetings have convened for 25 years and that this is the first one since 1999 to have finance as the main theme. According to the readout, quote, Xi Jinping emphasized that a strong financial nation should be based on a robust economic foundation, possessing leading global economic, technological, and comprehensive national strengths. It should also have a series of key core financial elements, namely, strong currency, strong central bank, strong financial institutions, strong international financial centers, strong financial regulation, and a strong financial talent pool. End quote. He also used the phrase, quote, independent, controllable, secure, and effective financial infrastructure system, end quote, which also appeared at the Central Financial Work Conference late last year, which we noted at the time. Xi Jinping then laid out a concrete definition for how China would become a financial superpower and called its system, quote, distinct from Western models, end quote. Major differences from the Western models, Xi explains, include the Communist Party's leadership and the emphasis on financing support for the real economy. Quote, is high-quality financial development, including but not limited to building an independent, controllable, secure, and efficient financial infrastructure system, really selective de-risking from the US-led global financial system, with one of the goals being to harden the financial system from the sorts of sanctions that the US and its allies imposed on Russia in the event the PRC were to take some sort of action similar to Russia's invasion of Ukraine, end quote. We continue to follow this space closely. The second speech, which is getting much more Western media attention, was from Premier Li Qiang at the World Economic Forum in Davos yesterday. In his speech, Li made the unusual move of announcing the official growth rate for 2023 before it was scheduled to be published today, expressing, quote, the just concluded year of 2023 saw a general rebound and improvement in China's economy. It is estimated that the GDP grew by about 5.2%. higher than the initial target of around 5% set at the beginning of the year, end quote. We will dig into these numbers shortly. Li's estimate is broadly in line with the average 5.3% pace in a Chinese financial media outlet Caixin's survey of economists, and compares with the 3% expansion reported in 2022, which was the second lowest growth rate in more than 4 decades, as the zero-COVID strategy in place for most of that year curbed economic activity. Market observers have long questioned the reliability and quality of China's economic data, not least because the impressive headline figure of above 5% comes despite weak trade data and slowing global demand, weak domestic data with low consumption, a years-long housing market slump, a declining population, and an exodus of foreign investors and capital. Of course, regular viewers will not be surprised. Quote, despite clear evidence that it was slowed down by unexpected economic headwinds this year, China will almost certainly claim to have hit its around 5% GDP growth target for 2023. The realities of a still shrinking property sector, limited consumer spending, falling trade surplus, and battered local government finances means that actual growth in 2023 was more like 1.5%. Looking ahead, China may see a cyclical recovery to perhaps 3 to 3.5% growth in 2024 as property bottoms out, although structural slowdown will naturally remain the dominant story for years to come. End quote. We will return to the economy in a moment. The theme of Li's speech was rebuilding trust, and speaking to the economic elite at the event, Li pushed similar themes we've seen out of Beijing in recent months. He discussed global challenges and structural changes, but did not mention Ukraine, Gaza, or the Red Sea in his speech. He also took the opportunity, unsurprisingly, to pitch China as a great investment destination and said his country was open for business. He also made the case for the bright prospects for the Chinese economy, saying, quote, "China has a vast market scale and is a stage of rapid demand release," end quote, and, quote, "China's commitment to opening up remains unwavering, and it will continue to create favorable conditions for countries around the world to share in China's opportunities. Choosing the Chinese market is not a risk, but an opportunity," end quote. However, as we have seen, a survey of top economists at the Davos event shows that the outlook on China remains poor, and that some corporate executives at this event and around the world listening may be suffering from some degree of promise fatigue from Chinese leadership in recent years. Next up, we need to look at this economic data. But just quickly, if you're enjoying today's video or getting some value from it, I have a huge favor to ask, and that is to like and subscribe. This is only 2 clicks of the mouse, but it is a huge help for me, and it's the best way, along with sharing the video, of course, to help the channel grow. And for those who want to help keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. The channel relies primarily on subscribers to keep going. Thank you so much, everybody, for the ongoing support. Let's continue. Okay, next up, we need to take note of the official numbers published today. I appreciate that some viewers will reject these numbers as being wholly unreliable, but at the very least it does give us an idea of general trends, and if official numbers are poor, this in of itself is very telling. According to China's National Bureau of Statistics today, the country's economy officially grew by 5.2% in October to December last year, missing expectations. As we have seen, GDP climbed 5.2% for the whole of 2023. In 2022, China's economy grew 3%, while in 2020, the initial year of COVID-19, saw growth of just 2.2%. This year's outcome was flattered in part by comparison with the relatively low base of 2022, when harsh pandemic lockdowns swept the nation, shutting down Shanghai for several months and crippling growth. Retail sales grew by 7.4% in December, year-on-year, missing expectations for 8% growth. Industrial production rose by 6.8% in December from a year earlier, beating the forecast of 6.6% growth. Investment was also lackluster in 2023. Fixed asset investment growth slowed last year, rising 3% for the full year compared with 5.1% in 2022. Private sector investment, too, remained weak, falling 0.4% in 2023 compared with a year earlier as policy uncertainty spooked enterprises. Private sector investment had risen 0.9% in 2022. Professor Michael Pettis of Peking University, who we often quote on this channel, observed on this point today, quote, "As always, the investment numbers are worrying. Given weakness in demand and discouraging remarks from manufacturers, it seems far more likely that the surge in manufacturing investment wasn't driven by new opportunities for productive investment so much as the need to replace plummeting property investment. The surge in private investment in industry, in other words, and especially in the high technology sector, may be driven by the same soft budget constraints that had earlier driven the property sector and still drives investment in infrastructure," end quote. Adding, quote, "Phenomenal GDP growth of just over 4%, aggregate financing in the economy rose 27% of this year's GDP, causing the country's debt-to-GDP ratio to rise by 16 percentage points this year, the second biggest increase ever. That seems like quite a lot of stimulus," end quote. This last statement coming as a pushback of sorts to the claims by some commentators that Beijing did not turn to much stimulus last year. Based on this relative debt-to-GDP increase, it does seem like stimulus was fairly moderate. Pettis has observed previously that debt-to-GDP is likely at around 300%. For China. For the full year last year, property investment fell 9.6%, while new construction starts dropped 20.4%, and home sales by value declined 6%. While better than the 28% drop in sales in 2022, it is still not a positive sign. One other surprising data was the almost 15% drop in steel production, which led to the lowest amount of output for any month since late 2017. Quote, "With investment in the property sector falling, the economy is more dependent on the manufacturing sector and service sector. This transition will take time to be accomplished. The key question in the market is when the transition in the property sector will finish." End quote. Employment is worth taking note of too. The National Bureau of Statistics spokesperson added that China's employment is expected to improve gradually as rates and trends looked better in the final quarter of last year. And interestingly, Beijing has brought back a youth unemployment rate after policymakers spent months tweaking their methodology on the figure that hit a record high last year. The National Bureau of Statistics now says that the jobless rate was 14.9% last month for those between 16 and 24 years of age, excluding current students. Analysts are especially skeptical of this rate, but we note it and move on. Finally, China's population shrank faster last year, falling by 2 million people. The 9 million births were the lowest total since at least the start of the People's Republic of China in 1949, and 11 million people died. While Premier Li Qiang was upbeat speaking to global elite in Switzerland, markets were less impressed. Hong Kong's Hang Seng Index tumbled 2.67% after the GDP announcement, while China's CSI 300 index shed almost 1%. It seems that the news from yesterday that Beijing is considering another 1 trillion yuan, $140 billion of new sovereign debt, only the fourth such sale in the past 26 years, seems to be doing little to help market sentiment. China last year also tapped into extra government bond sales to help the economy, taking the unusual step of raising 2023's fiscal deficit ratio to about 3.8% of GDP. TD Securities summed the numbers up well, telling clients in a note today, quote, "There was a lack of meaningful improvement in the economy. This makes the People's Bank of China's decision to keep its policy rate unchanged this week even more puzzling." End quote. Indeed, with the numbers as they exist now, if China wants to maintain a high growth rate for this year, while also pursuing a very ambitious domestic and international policy agenda, then much more fiscal and monetary support will be necessary, even as fiscal deficits reach new records, debt surges, and structural issues remain. This is the story we will be following this year, as well as concerning geopolitical flashpoints. Of course, in the longer run, China faces a daunting list of headwinds: a population that is rapidly skewing older and shrinking, high debt levels and local fiscal crises, and a worsening external political environment that has seen relations with the US-led wider West and some of its affluent neighbors plummet. 2024 is going to be one heck of a year, and I hope you will all join me on China Update as we follow along. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Wednesday, and I will see you all tomorrow.